Hello, everyone. Welcome again to our program. This is JJ Richa with Pismo Ventures with a live stream with Elko and Volker. I'm not going to try to say their last names. I'm going to let them do it because I know I'm going to mess it up completely. So welcome to today's program. It's really going to be about financing your venture, especially from a CFO perspective. Volker and Eelco are both CFOs, and they are both also members of TCA Angels. So just a little bit about the program before we get started. It's going to be about an hour. After introductions, we'll go into an open discussion and Q&A. We would like to ask you to ask questions throughout the entire program using the YouTube chat box that you have. So don't wait till the end because we will be answering questions along the way as we're going. Please also just want to tell you, if you have additional questions that we didn't answer or we can't answer, don't hesitate to email me at pvinfo@pismoventures.com. And if there are questions that are specific to Elko and Volker, I will forward them directly to them. Just wanted to talk a little bit about the program and the purpose. So the purpose of this program is really to help startups and entrepreneurs and the ecosystem understand and navigate the vibrant community by bringing on board thought leaders, investors, serial entrepreneurs, movers and shakers in our community, so we can add value to the listeners by providing really pertinent information about the current climate, about investment news, what it takes to be investable, how to grow your company, how to start a company, how to build it, potentially how you sell that company. I wanted to just talk very briefly about what Pismo Ventures does. So what we do, we are a venture studio, and we're kind of a venture firm and a combination of a venture firm and a virtual accelerator at the same time. We also have a software development arm. So we help businesses build the right business around the solution, around the solution they're trying to solve for the problem in the marketplace. We invest our resources, cash, and services. We develop software as well for our companies if that's what they need. Most startups need software nowadays. We also facilitate funding. We help open doors to make sure they're successful. We're also building a fund this year. Towards the end of this year, we should have a fund ready to invest in our startups, startup portfolio companies. We are a value-based hybrid cash and equity model to really help startups with their needs. We engage only on a month-to-month basis, and we don't have any long-term contracts. At the end of the day, we are true business partners and investors with, for our portfolio companies. So to get started, what I would like to do is I'd like to ask our guest to introduce themselves. Let's start with Volker. Volker, could you tell us a little bit about yourself, and then Elko, if you don't mind, you can follow after Volker is done.
Well, thank you, JJ, and a warm welcome to everybody who joins us. My background, in short, I was born in Germany. I lived in Brazil, Mexico, USA, and Switzerland. I worked for US, Japanese, and European companies, sizing from startups to Fortune 500. I currently own a business that provides interim C-level executives to deliver management solutions for companies in trouble or transition. My specialty is change management. I'm engaged with several companies as fractional CFO, and I'm industry agnostic and have expertise in industries ranging from flavor and fragrance to healthcare and medical device. I'm married for 30 years. I have 2 children, 25 and 27, and love old cars, new cars, fast ones, slow ones. I must admit, it's in my German DNA. And before I forget, yes, I like the Autobahn and certainly miss it at least once in a while. So that's for me. Elko?
Yeah, thanks. I'm also from Europe, but I am from the Netherlands, so a very small country compared to Germany. I studied there business economics and accounting at Erasmus University in Rotterdam, and I worked for many years for a Dutch technical group, worked in Germany, worked in Belgium, in the UK, and about every 3 to 4 years, the group put me in a different subsidiary, typically a little larger, but in particular with a lot more problems. In 2000, I became their financial US controller for a group of 6 material testing laboratories. And we tested all kinds of materials and parts for aerospace and medical clients. I moved with my family to Orange County with the idea to stay here for about 3 years. But it was such a great experience and the business developed exceptionally well. So we stayed longer. And finally, we grew our division to about 30 laboratories with about 1,000 employees. And in 2010, we did our leverage management buyout, where we were backed by a UK private equity firm. For me as a CFO, that was a real life-changing event because so much changed in the company. And also, we bought the company with only one reason, to sell it again. That went very well, and I will talk a little bit later about that event.
All right. Well, thank you very much. Okay, so just tell me how you pronounce your last name, Elko.
My last name is Niermeijer, so it's not as difficult as it looks like.
Okay, yeah, that's not. And Volker, how do you pronounce it?
The real German one is the Huther. In the US, you don't have the umlaut, it's the Huther. So either way.
Okay, either way. All right. Before I get started with asking questions to our guest, I would like to invite you to subscribe to our YouTube channel. You're on it right now. Just click that subscribe button. This way, it'll keep you abreast of all the upcoming events. And we would appreciate that. Also, please don't forget to follow us on social media. So it's much easier to reach you instead of emails. It'll be through the social media channels as well, whichever channels you like. Just visit us at pismoventures.com. All right, let's get started. So the first thing, let's start with Elko on this one. How did you get involved in angel investing, Elko?
Yeah, as I said, I had a liquidity event from my management buyout. And once I had a little bit of money in my bank account, there were quite a few entrepreneurs that started to approach me for financial help with their ventures. And I always enjoy to meet with people and learn about their business ideas and their dreams. And sometimes I really like their ideas, and I talked with quite a few startups, and that made me decide to co-invest in several companies. I have to say, I learned the hard way that angel investing has significantly more risk than more common investments on the stock market. And I learned that a great idea with a polished business plan and an exciting entrepreneur is definitely not a guarantee for success. About a year ago, I was introduced to Tech Coast Angels by David Friedman, the current TCA OC president. I visited several of the screening sessions at UCI, and I learned about the structured approach that TCA has to vet companies that are looking for money and or advice. And I thought it was very refreshing to see how the various angel investors at TCA look from very different perspectives to the companies that are pitching, and how you see all the different questions from people.
So it is not so all over the place. It's very structured, but at the same time, you get the perspective from different people with different backgrounds.
That's right. And it always feels that after we go through a pitching session together and there's more questions, that you get a better picture if that's an investment that fits for you. And you mentioned earlier the fund, and I have to say a great advantage in investing through TCA is that as the members now we have a fund. The fund is fairly tightly managed. And there have to be enough votes for the fund to take on a new investment.
Yeah.
I think that's a good approach, but also in that way, as an investor, you don't need to be present in each meeting without losing out on the opportunities that are considered by the majority of angels as very attractive.
Yeah.
And finally, I think it's very positive for the startups that the fund keeps investing in strong opportunities in difficult times that we're in at this moment. So.
Yeah. Wow, very good. From your side, Volker, what
Well,
made you?
it's a good question, a very good question. Don Castle used to be a neighbor of mine and a good friend, and he introduced me to Tech Coast Angels. So he said, "Come along, look around if you like it." And I really, really enjoyed it. In the multiple meetings, I really realized the caliber of people with their diverse backgrounds and interests. The knowledge base that the members have is just tremendous. There's nothing that hasn't been done, seen, or involved in. So you can really learn a lot from it. So the best part is that we openly share, learn from each other, and it's in a really non-threatening environment filled with humor. We laugh a lot and respect for each other. So
We sure do.
So believe me that there's much to be learned, and until today, I have never experienced anybody in the organization making fun or laughing about my potential deficiencies. Believe me, there's more than I care to admit. Allow me to quote Socrates, who said, "The more I know, the more I realize I know nothing." And being German as I am, that is really hard to accept. I'm just kidding, by the way.
That's okay. Okay, all right, that's good.
Okay.
So I just want to say that from my perspective too, it is smart money when we invest, because there are some investors, some of the TCA members that know industries really well, and they help us understand those industries, and then we end up helping these entrepreneurs succeed. So it's not dumb money; it's really smart money, because we're really helping the entrepreneurs really navigate and open doors for them quite a bit. So, all right. So, I'll next question for you is, Volker, is from your perspective as a CFO, how do you look at financing a startup and the different stages that you see?
Okay.
I think
Let me shift that around a little bit. Elko and I have an understanding, and there's actually 6 stages, and I'll take the VC side, and I'll let Elko do the angel side, if you allow me.
Oh, okay, sure, that's good. Yeah.
When Volker and I talked about this a little bit, we said it's important for people to understand the different points in the life cycle of companies, because where they are in the life cycle of a company, it means where they will probably get their capital resources from. It's also important to understand that as more money comes towards the company, the risk comes down. So there's like a negative correlation between risk and where companies are in the life cycle. And if we look at the first 3 stages in a life cycle, typically it starts with the ID investigation, where an entrepreneur or an inventor has an idea and wants to bounce it around and test it, which means that then you go to a second phase, which is typically the feasibility phase, where some work is done on a proof of concept. And then in the third phase, you go more into the final research and development stage, which is a stage where quite often the angel investors come in. If you go in the early part, so in the investigation and feasibility, typically it starts with the founders who put in some money. Then you see that friends and families put in some money. Sometimes you are able to get some grants or some government money. But for angels to get a real interest in companies, they want to see that there's some skin in the game from the founders. And skin in the game means that they've put in some money themselves, some time, and that there's a strong commitment to make it a success.
Okay, all right.
Yeah.
I just want to remind the viewers that they could ask questions throughout the program just in their YouTube chat box. These are the Q&A. It is live. We can see them as you type them. So because someone just typed a question right now, so you can type questions in your chat box on YouTube. We'll be able to see these questions and we'll be able to answer them as we're going through it. Volker, go ahead.
Thank you. So the next three steps, or cycles, if you want to call them, after the investigation, feasibility, and development, are now introduction, growth, and maturity. So if we talk about those three stages, once the proof of concept has been established, so the MVP, or the minimal viable product, and there's a clear go-to-market strategy, the company is really de-risked. And venture capitalists now get the appetite to join and support to fund the introduction and growth. Of course, in the case of the VCs, they have privilege of first sales because of the product introduction, and hopefully there's a track record on the past spending of the seed money. So fiscal discipline with accurate reporting and projection in sales on customer acquisition helps to get a more accurate picture of financial projection. So that's the benefit of being the VC, because you already have some experience, or there's some there. At least that's what we hope for. So the venture capitalist usually investment is much more of an amount between 2 to 10 million. And hopefully it follows then with an IPO or an M&A, or maybe even a strategic investor joining and taking over. So we all then, after that, hope there's a good exit, so beneficial for everybody.
So how do you think a startup financing differs from financing a mature business? You know, again, the definition of mature could be really all over the place, but maybe a mature is a company that's been around for some time. Maybe they have, in a single digit $1 million of revenue, or could be potentially larger, but they're trying to grow. How does that differ?
A mature,
Go ahead, sorry.
a mature business typically has established business relationships, has a couple of years of tax returns. So they are in a position to get a loan from either a bank or a lender. And for a startup, that's a lot more difficult. Lending money has a lot of advantages when it comes to keeping the value that you create with a business inside of your company. But it's not always ideal. And I think it's important to understand that even if you're a mature business, often it's expensive to take out a loan. Although in the last few years, of course, with low interest rates, the cost came down. Yeah. But to set up a bank loan with all the initiation fees and the loan management, it's quite something for a company. It also means that you have to repay principal every month. So you have to be very disciplined about your financial management. By the way, things are changing rapidly at the moment because money was cheap through loans, and a lot of companies borrowed a little bit more than what they should in compared to the equity that they have. And what we saw in the last probably in the last 12 to 18 months, where a lot of companies were borrowing money to buy back their shares. Yeah. I believe that's now come to an end for almost all companies. Maybe a few tech companies will continue that. But even mature companies will find it more difficult to get bank loans and might go back to more equity, something that startups are more used to.
So, Volker, so it's the same question, but I'm gonna put a little spin on it. From a CFO perspective, or maybe from a financial projections perspective, is there a difference between a startup looking for money versus a mature business?
Oh yeah, of course. I think the startup has to first of all, it has to show and prove, as we said in the life cycle, it has to show a product that makes any sense, that they are able to go to the market with it and be able to sell it. So looking at figures that they have to basically invent. They don't know exactly how much are they going to sell about it, how much are they going to make with this. So they're going to have to be very creative and try to find precedents on those products or what they can do. Versus a company that's mature and that is already selling the product, and you can say, well, based on your past, you've done this, so we figure you're going to do this if there's no change in it. So yes, the financing on those two sides is different, and also the way we evaluate the companies, I think, in a sense, between being in a seed stage or on a VC side.
Yeah, it's going to be there. Potentially, there's some true valuation on a mature company versus a startup that has very little track record.
Absolutely.
So okay, so we have a question online. I'm going to put it on the screen. Let me switch the view a little bit so we could show it. Here we go. It says, is it safe to assume seed investment less than $2 million for angels and VCs will show interest only in round A, or seed requesting more than 2 million? Either one of you.
I'm trying to get the question in parts. So
yes, I'm not sure I understand it either. So
okay, so I'm gonna try to hit it, and Musami, if I don't, please just send a message to us. The seed money, yes, it's less than 2 million. Does VC have 2 million, go in 2 million? Yes, they do, but usually the angels don't go over that amount. I would even say that the angels go between 25,000 to $500,000, not even to 2 million. Sometimes you find if you go into funds with the angel investors, you might get up to the 2 million. So
and syndications as well.
With syndications, correct. Will this show interest only in round A? Well, it depends on what kind of product or what kind of negotiation skills we have as angels. What do we get for our money? Is it, and we can talk about that a little bit later about, are we going to get common stock, preferred stock, are going to go safe notes or convertibles? But that's an expertise I leave up to Elko because he's very good at it. But I think that's if that answers the question, please let us know. And if it doesn't, I'd be glad offline to discuss it with you in person as well if you want to.
So so they clarified. I'll put it up on the screen. Angels below 2 million, VCs above 2 million. So that's a little bit more of a clarification. But I'm just gonna say before you answer, Volker or Elko, is that the seed definition is changing over time, and so I don't know if seed is 2 million. Seed could be 100,000 too. It doesn't have to be 2 million. Seed and VCs also, they've changed depending on what kind of VC you're going after. But some VCs are 3 to 4 million and up, and could still be that 2 million and under is really an angel deal. And I don't know if it's seed, it could be Series A as well. So there's too many definitions around what a Series A, what a seed is. But I think Volker answered the question. So maybe we'll move on to another question. So this is from Troy. I'll switch around because it's easier to see it this way. How are you going about reassessing recent TCA fund investments given the rapidly changing macroeconomic outlook? I imagine at least some investments don't look as attractive anymore. Elko, you want to take that on?
Yeah, of course. And
I'll put it back up.
Definitely valuations are changing. It's really important at this moment for investments that there's enough runway so that people who are looking for money don't run out of money 6 months later, but have a longer term plan with a very good plan to go to market, to do their introduction of their product or their service, and also what their exit strategy is. And a company that is developing something that can be of a huge strategic advantage of a larger company will be in a much stronger position than a small company that is looking into a consumer product and wants to stay in that market by itself for a long period of time. So it's a risk reward equation that we have to look very careful at. But let's not forget that for quite a while, a lot of startup companies had a tough time to find really excellent employees, and that's something that's changing now. So there are advantages to the current situation. Yeah.
Okay. All right. Volker, can you maybe comment on that, since you talked about the fund? So can you comment about maybe the fund is really an advantage that we have right now?
I think it is, because it diversifies our risk in a bit, in a sense that we don't concentrate only on one company, so on many companies. By the way, Jim Pickel is an excellent fund manager. He keeps us all honest and true, and making sure that we do what we have to do when we do our due diligence. Has the due diligence changed? Yes, it has. Admittingly, we do ask questions that we didn't do before COVID. We have a questionnaire. We do ask, how long is your money going to last? What do you think about your financing in the future? Are you going to think it's easier or more difficult? What do you do to cut costs, to make sure that there is a, look ahead? What is the new normal? And redefine your business model post COVID. So we do stress the P&L and the balance sheet and the liquidity, yes, of course. And I think we do more of it now than we did before.
All right. This is another, I think, relevant question. Not this one. I'll put that back on in a second. It's this one. You mentioned early sales projections are made up, and so at the early stage. So for pre-market financial projections, how much detail is scrutinized during fundraising at seed stage?
Okay, I'll take that one on if I may.
Because
I did say it, didn't I? I did say it.
Yeah.
Well, in a pre-market, it is difficult to say, you know what, and everybody talks about, I'm in $1 billion market and I only want 1% of it, and I'm going to do that with 2 salespeople. That's it. No problem. I can do that. Well, it is difficult to believe. So it needs to be realistic. We'll poke at it. We'll ask. We do have some expertise. A lot of TCA members have expertise in those fields, and they know what's realistic. So stick with the realistic figures. Try to be not necessarily modest, but be honest about it. And we don't really have a magic number where we say, you know what, the market has to be 900 million or it has to be $1 billion or something. We do look at market niches as well as we look at when you swim with the sharks. So it's all over the place. Realistic numbers is what we like to have, concise and precise, and I think that's the magic to it.
I would say really realistic assumptions. You got to have assumptions, but they have to be realistic. Yeah.
Correct.
All right. Maybe Elko, you can take the next one. This is from Randy. Randy says, COVID has now severely impacted many personal finances and access to friends and family. How can they be creative to find other ways to check box of skin in the game of raise a seed fund?
Yeah, that's a very good question. And one of the examples I like to give is that there are great, what we call, inventors, intrapreneurs, so entrepreneurs who work for larger companies, who lose their job and who are now on their own. And they are perfect people to start a new venture, come up with an idea, and maybe live on a little salary for quite a while, but build up something that they've always been dreaming about. And it's not only about money, it's also about time, and it's about a commitment of the team that you build up. So there are certain certainly good ways at the moment to enter new markets, be innovative, and to be successful.
Yep. Let me ask you a question on financial instruments. What financial instruments do you usually come across? Either one, Elko or Volker.
We have, of course, there's the common stock, the preferred stock, the convertible notes, the safe notes, as we mentioned earlier. I'll tackle on the common stock because I like the common. It's the most basic form of equity instrument. It represents an ownership and interest in a corporation. It includes an interest in earnings that translates into declared dividends. It has interest in assets to distribute upon dissolution. Unfortunately, as per name, you're just common, meaning that you will only receive money if company goes bankrupt until the creditors, like bondholders and preferred shareholders, have received their respective share. The upside to common shares is that they usually outperform bonds and preferred shares in the long run. Not in the short. There's more volatility in the short run, but in the long run, usually is the upside on it. There are several disadvantages in issuing common voting stock, like the dilution of management's interest in the corporation's growth, an increase in the voting power of non-management stockholders, and investors must bear the maximum risk of losing their investment. So this makes common stock riskier than debt or preferred shares. So by the way, just a small fact that the first ever common stock was established in 1602 by the Dutch East India Company and introduced to the Amsterdam Stock Exchange. So, and with that, I hand it over to my Dutch colleague, Elko.
Yeah, thanks. Apart from common stock, we also come across preferred stock quite a bit. And of course, it's another equity instrument. But preferred stock, it represents a hybrid. And that's in the sense that it's an equity interest with certain futures that resemble debt. Preferred stock has a preference right over common stock, and often that's with respect to the dividends and to liquidation proceeds. In other words, it has a priority when dividend payments and liquidation distributions are made. And if desired, dividends can accrue at pre-established rate and can be paid on a cumulative basis when cash flow of the startup actually permits to pay the dividends. Also, preferred stock may be voting or non-voting, or it can be entitled to certain redemption rights. So there's quite a few advantages of preferred stock. For the issuing party, so often for the founders, an advantage of preferred stock can be that there is no dilution of the founder's interest in the corporate growth or in the voting power. So there's some important topics to look at when an entrepreneur wants to finance and he wants to use either common or preferred stock.
Okay.
Volker already mentioned that it's also possible to work with notes. Convertible notes is one example, and safe notes is another example. And convertible notes have been, I would say, one of the most popular instruments for seed investments for quite a long while. And as a result of that, a lot of seed investors are very familiar with convertible notes. The note starts as a note that bears interest, and they have a conversion mechanism into equity. And a big advantage can be that the share price of the conversion does not have to be determined when the convertible is issued. So you don't have to go through a process of a whole valuation and negotiation with potential shareholders, because you give them a convertible note. Safe notes, and SAFE is the abbreviation of Simple Agreement for Future Equity, has been very popular, I would say, in the last 2 to 3 years. And safe documents are even shorter than convertible notes. And that's for the reason that they have fewer negotiated terms, because safe notes, typically they don't carry interest and they have no term. And the fact that they have no term is what a lot of investors like, because there's not a time pressure that by a certain moment they have to convert from the debt into equity. A lot of safe notes come with either a discount or a valuation cap, which means that the investors know that at a later moment, when more money comes in, that they still get a pretty good deal to get their shares. So another big advantage of the safe notes is also you don't need to do a valuation and negotiation about the stock price. You do that later when the company is more mature or has at least gone into a further phase in the life cycle of the company.
Yep. So I'm going to mention that we've seen a lot of convertible notes in the past few years. In general, I'm going to say that preferred or equity, a preferred stock investment is the preferred method or instrument for investors. From a Tech Ghost Angel standpoint, and also from a Pismo Venture standpoint, we don't do safe notes because it is one-sided, more towards towards the startup company, and the investors or TCA or in general, they don't have as much recourse to be able to go after the money. Again, TCA has, at least TCA OC has made a decision not to do safe investments. I'm going to, ask a question from Paul. And Paul says, here we go. You stated that founders, friends, and family need to put money before angels will come in. How much should that be, and in what ratio? So, either one of you can take it, but I don't think there is a specific, ratio or specific way to do this. But go ahead, either one. Volker, maybe you can take that on.
I'll try to tackle it. It's a very good question, simply out of the fact because there is nothing. There's no correct answer or wrong answer, and it's upon our own interpretation. We've seen companies where the family and friends put in $2 million in a business and they have a value of $4 million, which is one number. But we've seen also people who said, I invested $5,000 and my father-in-law invested $5,000 and we think the company's worth $1 million or $10 million or $100 million. Yeah. It really depends upon what it is all about. Some people, you can see they have multiple investments before, multiple IPOs, and they come in and they tell you, well, I actually invested $50,000, but tell you 2 sentences beforehand that they made $100 million on their last IPO. Doesn't quite equate, doesn't quite challenge us, and it doesn't feel good. But there's no magic number. What we do want to know is, and that's the reason we ask, is, as Elko said earlier, do you have some skin in the game? Are you committed to the product? Are you committed to this project? Is your family behind you? And it's not necessarily always the monetary terms, but it has to do with the fact, is everybody convinced? Remember, when we look at you, we see you tell us something, and we trust you. We will trust you. But it's nice when you can give us evidence of trust from your inner family circle that says, yes, we think he's great. He knows what he's doing. That's basically what it boils down to.
Okay, all right. There is a question by Pi. Hold on 1 second, and here it is. All that's been stated is easily sourceable. Where will this impeding economic depression, where both demand and supply are decimated, take promising startups? Pure government subsidization? Elko, any ideas?
Yeah, I understand the concern of Pi, but I also think it's really important that that entrepreneurs and startup founders really look into what are industries and sectors that are promising. I mean, no one is going to start an airline company at the moment. But if you find innovative ways to quickly respond to the changes in the markets, then it's not so much about the fallback in the sectors. It's about how can you best address the opportunities that suddenly come to the surface. And I would not be surprised if there's going to be a very big market soon, for example, for safe working places in Starbucks or in other office suites. It's very likely that a lot of companies will go to much smaller office buildings and allow more remote work from home and other spaces. So how can we best support that development? So there's a lot of opportunities that just have to be worked out, and I'm sure that there's capital to support that and to grow it, and certainly from places like TCA there is advice to help entrepreneurs to achieve those dreams.
Yeah, thank you very much. I'm going to display a question for me, Scott. Good to see you. Thanks for joining us. So to answer your question, TCA does priced rounds or preferred rounds and convertible notes. We just don't do safes. That's the answer to that one. Volker, there is a question for you next, and that is from Brian. Are you suggesting angel willingness to invest is influenced more by their circumstance than a set of financial rules? Maybe an example like Elko's introductory story.
Well, Brian, it's not. After all, I am a finance guy, so I'm a CFO. So yes, I am influenced by numbers, definitely. Are there established rules? There are certain guidelines that we all have, but they're individualized. I don't think we can go to ask Elko or JJ or anybody in the group and say, hey, what is your guideline and is it the same as I? No, it's not. But we are influenced by circumstances, absolutely. We look around, we're trying to get our own picture on what is it, be it a problem. Sometimes we might be even an impact investor, meaning that we've been confronted with a problem. So it is much more of something that drives home to us than just the numbers and per se. Be it, for example, a cancer issue. Somebody in the family had a cancer problem, and you now find there's a company who has some medicine that drives much more home than necessarily somebody with, another tool to fix a car. So I think, to answer your question in short, there is, for me, I don't think there is a financial rule, but I do look at numbers a lot, and I'll try to make sure that they make sense to me.
All right. This is from Dave. I'll let you take it, Volker. Regarding mutual vetting, do you have an established portfolio or interest regarding healthcare SaaS? Just want to let you know, Dave, that we just invested in a healthcare SaaS really a few days ago. So we do. But go ahead, Elko. I'll redisplay it.
Yeah, we at TCA we certainly get quite a lot of healthcare pitches. There are some very good ones, some very promising ones, and there's also some that are really difficult to vet. And we are lucky that within TCA we have quite a few experts that have medtech and health tech backgrounds, and they typically are really important in the due diligence process. It is definitely a sector where if something goes really well, it can be a real big success. So we will always keep looking at that.
Yeah. Okay. All right. That's good. We do have expertise in almost every sector. It's really that's I think the power of diversification that we have at Techos Angels. Question, I could start with you, Volker. How do you see, we kind of touched on that, but maybe you can expand on it. How do you see the financial impact of COVID-19 on startups, and what advice do you have for entrepreneurs?
Well, let me call it this way. I call it's actually a leadership challenge. Okay, COVID is unlikely any previous crisis. There's no traditional crisis response that is sufficient for this issue. So I advised my clients, prepare and be thankful if it does not eventuate, but a wait and see approach is a non-starter. So don't even think, I'll just wait it out. It's not going to happen. The recovery will not be a quick bounce back. So plan for multiple quarters of lower revenue. We're going to stress test your P&L and the liquidity. And maybe you should have more of a customer-centric view on your business. Cash is king. There's a high likelihood of substantial revenue disruption, which exactly is what's happening right now. It leads to potential liquidity crisis for financing. Then plan and implement immediate actions to preserve cash, whatever that entitles.
Whatever that may be, yeah.
Customers will change their behaviors. Count with radical business model changes, not the simple ones. At the CEO level, it's critical to be out in the front. You have to be transparent and clear, not only to your team needs guidance, but also your customers. And big magic word is communicate. Speak, communicate. You can't over-communicate right now. Let people know. Understand the supply exposure. They analyze and prioritize where it needs to be done, and look ahead at the new normal. Redefine your business model post-COVID. And I think there's also a positive side, and most people forget that, but this is also an opportunity. Yes, of course, it's a threat to business, but if you have a positive attitude and a smile on your face, this can be the situation to build trust, loyalty, and long-term relationships, not just with your team, but also with your customers. So it's not the time to be defensive, but to be on the offense.
Yep. I'm going to take this next one on from Mike. Mike says, does TCA invest in innovative nonprofit companies? So the answer to that is nonprofit, which means investors, TCA, they're looking for return on investment. Since nonprofits will not have potentially a return on investment because they won't have an exit or an acquisition, the short answer is no. It's got to be for profit. There are a lot of organizations that are here in Orange County. If you want to reach out to me afterwards, Mike, I can point you in the right direction. A lot of foundations that grant and invest in startup companies that are for nonprofits. So, but TCA as investors are looking for multiple returns on their investment, which nonprofit cannot produce. Elko, I'm going to put the next one for you. It comes from Brick. What is the MRR or ARR minimum requirements for TCA when seed investing in a commercial real estate SaaS startup? Seems like the ones I've pitched to are looking for $10K a month or $120 a year on average.
I have to be honest, that is not a question that I can answer.
Okay, Volker, if you can take it on, or I can.
I'll try to, but I think the answer to that question is similar to what we said earlier. I think depends on the investor, and it depends on the group you're investing. There's a couple of people who are really savvy in real estate, and they'll probably give you a different answer than I would give you, because as Elko and I would say, 10,000 sounds good, but savvy investors in the area would probably say, no, it's a different number. So again, it depends on the investor and on the group you're investing with.
I'll agree with Volker, and I'll say that what we're looking, if you have some recurring monthly revenue, is definitely better than not having anything, and it shows that there is a demand or someone likes what you're providing as a SaaS. So it really going to depend if other SaaS that are similar to you, how's your value proposition different than them, and is the MRR or the annual ARR, is it comparable to potentially what others are doing, and can you really do better, and how are you better than them? So really there's a lot of variables, but I would say having any MRR is good. All right. So Elko, how about talking a little bit about, we have just about 10 minutes left, so let's talk a little bit about TCA, and you are the chair of events and education at Tekos Angels. Can you tell us a little bit about your vision, about your role, and what is TCA trying to do this year when it comes to events and education?
Yeah, we've recently started with a new executive committee under the leadership of David Friedman as our president, and he has some very good ideas of how we can further build out TCA, help to make better investment decisions, but also help to better help the investment community and the startup community. And one of the areas that I'm responsible for is the education part. So we're trying to do at least monthly lunch and learn sessions, where during pitch events we have presenters that teach us about new developments, often around technology and innovation. And to give you a few examples of topics that we're looking at is artificial intelligence, machine learning, cybersecurity, 5G developments, battery development, big data and augmented analysis, and quantum computing, nanotechnology, and material science. So all fairly high-tech areas where we like to better understand what's happening in all the developments and innovation, so that once we get pitches from companies that are operating in those sectors, then we are better positioned to understand exactly what they do and what their future plans are. Secondly, we have the events that TCA is part of and that TCA organizes. And one of the nice things about the angel community is that there are many different angel groups, and we don't compete, but we help each other. And that's because if a company is pitching, the more angels we can find to be interested in the pitch and to quickly close the round, it means that the entrepreneur has his money, doesn't need to go on a roadshow for many months, but can focus on his new ideas. So as angel groups, we help each other, we strengthen each other. And one of the bigger events that we hope to organize at the new Cove at UCI, once we're back to a more normal situation, is the One TCA event that we try to organize together with the Executive Next Practices Institute. And that event currently has the working title Innovation for Rebound, Reinvention and Revenue. And we hope to do that with a lot of participants, visitors, and startuppers, hopefully in the month of August.
Okay. All right. Well, that's good. Volker, let's answer one more question before you tell us a little bit about what you're doing for the partnership chair committee. So how do you typically value a tech SaaS startup who is in a pre-launch stage, pre-revenue?
Yeah, I keep trying to emphasize that there's very few typical evaluations or typical ways of evaluating a company. It really isn't. There is no here is the amount that we need to see before we say yes, because between all of us we have different thresholds. So that makes us different. So there is, in my opinion, and I'll be happy to be corrected, but there is no typical in any of those evaluations. It's a mutual feeling, it's a mutual understanding, and of what's going on in a pre-launch stage or in any other stage, of as a matter of fact, for a company. So I don't have I don't have an answer for that specifically where I say this is it. I think it all depends. The only advice I can give is if you are pitching and you have a SaaS startup in a pre-launch, try to find out who you're pitching to. Okay, the best way to find out is to see what they've done in the past, and that way you get a better feel for it, and it's easier to communicate with them. If you talk to me about cars, I'm happy. I love cars, so you can talk to me about cars. I understand cars, but when you talk to me about certain, what can I take? Certain other things, and I don't come anything to mind at this moment, but there's certain things where I don't even I'm not interested. So for me, I can't even give a value to it. So I'm out. So try to pick investors that have a certain clue about what you're doing, and that makes life much easier for you as well.
All right. Before I ask you the last question, and I'll answer a couple of questions here, I want to remind everybody that we have a Monday at 11 program every week, and it's going to be with a different thought leader. Also, again, don't forget to subscribe to our YouTube channel. We need that. We need you to stay abreast. Also, follow us on social media. Phil Gill is asking you a question, Volker. He says, forget cars. What are you using for your mic and ear jack? So,
I'm so sorry. It's cheap. It's called Logi. Very cheap. I didn't think we're going to be that bad on it, but sorry if the quality is not.
It sounds good to me. All right, so
I think JJ normally he wears those in his cars because they are so loud. So
that's what it is, huh?
That's
Volker, tell us about your plans for TCA as a partnership chair.
Certainly. So I mentioned earlier that the attraction for me was the members' knowledge, the OC fund, which is really good, and the desire to be part of being a catalyst for helping entrepreneurs to succeed. So there's an intrinsic value to help and being part of a successful venture. So my plan is to promote our activities by being part in the ecosystem, which consists of some very fabulous organizations, which some people haven't heard of, but OCRA, Orange County Regulatory Affairs, the Vice Alliance, Women in Bio, Irvine Chamber, the Monday Club. It's just to mention a couple of them. And a partnership for me is always a giving and taking. And as I used to hire people, I used to tell them, leave it in a balance. If there's an inequality, then we need to talk about it and bring it back to a balance. So it's not a one-way street. It's a giving and taking. So I'm happy that we are and TCA willing to give, not just financially, but also in the sense of advice and networking. And we do solve problems for many of the organizations, not just financial ones. So there's about 300,000 angels out there and about 300 groups. There's about 900 VC firms and a multitude of organizations that are an important part of the economy, and they're promising companies. So I have my work cut out there, and I can't tell you which ones I'm going to meet, but I'll try to meet as many as I can. And again, I'm really honored to be a part of TCA, not as just a member, but also as the chair for partnership, ecosystem, and business development, as I call it. With that,
there you go. Well, thank you very much. Just want to mention to everyone that next week we have Lisa Walker. She is the vice president of Tech OC Angels Orange County. She will be talking about marketing as a lifeline for startups. In my opinion, this is going to be a great subject because most startups really underestimate the importance of marketing, especially at an early stage, which is very huge. The week after that, we have Grant Van Cleve, who is the chairman of TCA Angels. He will be on board on May 18th to tell us about his super angel investment journey. He has more than 74 investments so far, and he sits on dozen boards. So I think it will be really great to hear from Grant as well, and he's a current chair of TCA Angels as a whole. Elko, thank you so much for being here today. I really appreciate you being with us. And Volker, thank you for being here. And I really wish you both the best of success in your journey as being chairs of these two very important committees.
Thank you.
Thank you, guys. Have a good one, and we will see you next week. Thank you, everyone. Bye-bye.
Bye.